Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Friday everybody. Most of yesterday's video was on the messy reopening of China, which continues of course into this week, and the pressure surging cases are putting on China's health system. For today's video, let's take a break from that and focus on the economy and geopolitical developments. And first up, we have the economy. Today we have very mixed news, and let's start with the bad news first, and it is quite bad. On Thursday, yesterday, we got a lot of official data for the month of November, and while the data were unsurprisingly poor, it was worse than expected. Retail sales in China tumbled 5.9% in November year-on-year, while industrial production lost momentum as factories grappled with tight COVID restrictions and slowing overseas demand for their products. Investment in buildings, machinery and other fixed assets slowed too. Unemployment in big cities rose to 5.7% from 5.5% in October, with the old victim of history's vicissitudes once again on the front line of the pain: the poor and the young. Unemployment among migrant workers rose to 6% from 5.5% in October. Of workers between 16 and 24 years of age, 17.1% were unemployed, down from a record of 19.9% in July, but still very high by modern Chinese standards. Business and consumer activity slumped to their weakest levels since the Shanghai lockdown at the start of the year. And then there was housing. New home prices in 70 cities, excluding state-subsidized housing, slid 0.25% last month on month. The previous month, the prices had dropped 0.37% month on month. Thus, China's market has seen month-on-month decreases in prices for almost a year. In November, sales dropped 31% from a year earlier, worsening from a 23% decrease that we saw in October, suggesting that even with now massive government support, the market is still not stabilizing. More on the property sector soon. In short, the data for November are not good. Quote, "The November data were way below consensus, pointing to a worsening slowdown. Surging COVID infections will offset some of the positive impact of the easing in the near term. The road to full reopening may still be painful and bumpy." End quote. One analyst simply stated, the Chinese economy is in trouble. Even some Chinese government economists are beginning to sound quite desperate. Quote, "The window left for us to reach China's 2030 per capita growth goals is only about 6 or 7 years. Therefore, I proposed setting next year's target at above 5%, and we should strive for a growth rate of 6%. When the economy is back on track, I think 6% is an achievable goal." End quote. Other analysts expect a growth target of around 5% to be announced for 2023. Now, China can do it, but by Q4 2023 and Q1 2024, it would be unsustainable without a massive accumulation of debt to finance it, including speculative money being pumped back into housing. And of course, it just further kicks the can of structural reform down the road. Quote, "I think they will be able quite easily to achieve a 5% growth target. I also continue to think growth in 2023 will be relatively high quality, as we see a partial reversal of the steep contraction in the consumption share of GDP during 2022. But even if this sets off a China is back sentiment, it won't be sustainable. Not only will Chinese imbalances remain incredibly deep, but China will not even be able to recover much of the ground lost in the previous 3 years. And so much of the growth it does achieve will be given back in the form of a more costly future economic adjustment." End quote. Okay, next up, and just quickly, also yesterday, Thursday, we saw another high-profile commitment from Beijing to boost the property sector. Vice Premier Liu He, in a written speech delivered to European business leaders at the so-called Fifth China-EU CEO and former senior officials dialogue, quite a mouthful, that event, expressed that regulators are preparing more policies to boost market confidence, specifically in the property sector, and emphasizing that, quote, "the real estate sector is the pillar of our economy," end quote. In the year-to-date, housing sales have plunged by almost a third year-on-year, and as we just observed, the situation month-on-month has still not reversed. Hey guys, if you're enjoying the episode, don't forget to hit that like button, it's a huge help. Subscribing and sharing is also a huge help. And as always, anyone who can go that extra mile and help keep the channel itself sustainable, financially sustainable, Patreon and Buy Me a Coffee links are in the description below. Like I said, once again, thank you so much everybody for the ongoing support. Now let's continue, and last up for the economy. On Thursday, US regulators said that they had been allowed to inspect the work of auditors in China for the first time. Yet another sign that 200 Chinese companies are less likely to be thrown off American stock markets. Companies such as Alibaba, JD.com and Baidu Inc. were on course to be delisted starting in 2024 under US legislation that bans trading in stocks whose auditors cannot be inspected by the Public Company Accounting Oversight Board. This development is a big deal and a significant breakthrough after more than a decade-long standoff between Beijing and Washington. Beijing had resisted US audit inspectors for years over fears that they would gain access to sensitive data. Quote, "This is remarkable. This entire audit episode should be a case study in how you can negotiate concessions from the PRC government if you have something it wants and you have fortitude and institutional support." In this case, the PRC leadership realized that having their firms delisted from the US financial markets was a step in decoupling they did not want to take, and the US side had little room to give and could resist lobbying from various quarters because the Holding Financial Companies Accountable Act of 2020 made concessions impossible. End quote. We remember that China agreed in August to let the PCAOB examine work papers from Chinese auditors. But, as UK-based Japanese-owned Financial Times writes yesterday, quote, "The agency had signalled that it was sceptical it would receive unfettered access." End quote. Although inspectors have not yet been allowed into mainland China itself, a team spent nearly 9 weeks in Hong Kong examining audits conducted by the mainland affiliate of KPMG and the local affiliate of PricewaterhouseCoopers. US regulators expressed yesterday that so far, so good, but warned that, quote, "If Beijing starts to interfere with inspections in the future, the agency would move to immediately restart the delisting threat." End quote. Okay, now it is time for the quote of the week, when I read a statement which typically speaks for itself. This week, a transcript of the PRC ambassador to France's comments to journalists at a reception on the 7th of December was published on the embassy's website. This is actually the first time that a senior Chinese official has discussed publicly the rare protests which we saw break out in China a few weeks ago. According to the ambassador, based on the official transcript, the main cause of the protests is clear. Foreigners. Quote, "In the beginning, I think the Chinese public initiated the protests to express their dissatisfaction with how local governments have failed to fully implement the central government's policies, but the protests were soon being taken advantage of by foreign forces. We can clearly smell the color revolutions that have occurred frequently in the developing world in recent years. What I said is based on evidence. Some Chinese are bought by outside forces." Question, "By whom?" Answer, "Outsiders." Question, "Who exactly?" Answer, "I can't put my finger on it. It is the external anti-China forces." End quote. Okay, next up, and finally for today's video, the frictions at the China-India border could be much more dangerous than we initially thought. According to a report by the UK-based The Telegraph, border clashes between India and China occur quite often and are, quote, "covered up," end quote. The outlet writes, citing several unnamed sources, that several incidents are taking place at the northern state of Arunachal Pradesh every month, with soldiers from the two powers sometimes, quote, "engaging in violent hand-to-hand combat, often using clubs and other homemade melee weapons." End quote. One source, which the outlet says is a senior Indian Army officer, expressed, quote, "Face-offs with the People's Liberation Army have become a common feature along the border," end quote, adding, quote, "They have happened on average 2 or 3 times a month recently, and the incursions have increased in frequency over the last 2 years," end quote. The source expressed that they get instructions from the central government to not discuss the incidents publicly. Indeed, this week international media has been reporting on a video of what appears to be a previously unreported violent clash between Indian and Chinese troops at the Himalayan border from September of last year. According to Indian media this week, the most recent violent clash, which we covered earlier in the week, resulted in 34 Indian and 40 Chinese soldiers injured. Needless to say, with the real risk of unintended escalation, these violent exchanges between these two nuclear-armed Asian giants are incredibly dangerous. Okay, that is today's episode of China Update. Thank you so much everybody for watching. I hope you have a great weekend ahead, and I will see you all tomorrow.